Trading with a trend is one of the most effective things a trader learns, and using an engulfing pattern is one way to get into trending moves just as momentum is picking up. These engulfing candles indicate a strong shift in direction, and when combined with observation of the price trending direction that precedes it, this combination creates the opportunity for an efficient trading strategy. An engulfing candle is a candle whose length completely covers the previous candle, with a close above the high or below the low of the previous candle. If the close is above the high of the previous candle, then it's a bullish engulfing candle, and that signals buying pressure, while if the close is below the low of the previous candle, it's a bearish engulfing candle, and this signals selling pressure. In other words, engulfing candlesticks are reversal patterns. A bullish engulfing candlestick formation implies that bulls are in full control of bears. As the pattern shows, the green body covers completely the red-bodied candle. This shows the readiness of the market participants to drive the price higher. What about the shadows or the tails? Do we include them in our analysis? In a perfect scenario, a bullish engulfing pattern should include the shadows of the candles. A real bullish engulfing pattern forms when the green body of the second candle fully engulfs the whole previous candle, including the tails. Here, the opinions diverge into two schools. One is preaching that the best bullish engulfing pattern forms when both the body and the tails are engulfed. The second school believes that for a bullish engulfing pattern, it does not really matter if the tails are engulfed or not. What matters is only the real body of the candle. My personal style towards the bullish engulfing pattern is that the real body is the most important element. It is great if tails are engulfed, but it is not the end of the world if they are not. Sometimes the wicks can offer a degree of noise in the market. That's why I concentrate on the real bodies. I use the wicks as an indication of where to place stop losses and potential targets, but for me, they are not as important to validate the bullish engulfing pattern. So, here are some great examples of bullish engulfing patterns I would have considered as valid. As you can see, the red body of the first candle is fully engulfed by the second green candle. The lower tail of the red candle is not engulfed by the green candle, but for me, this is not important. What matters is the real body of the candle. As long as it fully engulfed, I would classify this pattern as a bullish engulfing candle. How to read a bullish engulfing pattern? When a bullish engulfing pattern forms, I expect the price to go higher. More market participants are willing to buy than to sell that particular instrument. That is an indication for price action traders that more buyers will join the trend and it will be extended to new highs. Here's an important observation. There are many variations of bullish engulfing patterns. One thing to remember is to learn how to read the pattern. You need to understand that if you have a red body and then a series of green-bodied candles, you might still have a bullish engulfing pattern. What matters is to have the green bodies engulfing the red body of the previous candle. Have a look at this example. We have a two-bodied bullish engulfing pattern. So very important, it doesn't matter how many candles you have forming a bullish engulfing candlestick pattern. What matters is that the body of the red candle is fully engulfed. Here we have multiple candles forming a bullish engulfing pattern. Again, what matters is that the red body of the first candle is covered by one or more consecutive bullish or green candles. If you are a price action trader, don't restrict yourself to the classic engulfing pattern. Open your eyes and search for multiple candles forming a bullish engulfing pattern. The bearish engulfing candlestick pattern is the complete opposite. A bearish engulfing candlestick is a small bullish candle followed by a larger red bearish candle covering or engulfing the small green candle. Just like the bullish engulfing, behind the bearish engulfing pattern stands pure price action. What matters is that the number of sellers outweighs the number of buyers. From a price action standpoint, this means that the bulls are too weak and bears take control of the action, thus pushing the price down. So bearish engulfing candlestick patterns are extremely strong continuation patterns in downtrends. The power of the bearish and bullish engulfing pattern is in following the trend. They are most powerful when the market takes a break, makes a correction, and then forms an engulfing pattern. This is probably the best place for an engulfing pattern to form. So how to trade using engulfing patterns? The first step in applying an engulfing candle strategy is to determine the dominant trend direction, namely the direction you will trade in. An uptrend is defined by higher highs and higher lows in price. In an uptrend, the advancing waves are larger than the pullbacks, pushing the market higher. During an uptrend, you should take only long positions, buying with the intention of selling later at a higher price. A downtrend is defined by lower lows and lower highs in price. In a downtrend, the declining waves are larger than the pullbacks, pushing the market lower. Once the trend is established, you wait for a pullback. Waiting for a pullback means you're getting a better price for the next wave of the trend when it unfolds. Very important, if the trend is up, watch for the downward pullback. The pullback should not drop below the low of the prior pullback, as this violates the rules of an uptrend. If the trend is down, watch for an upward pullback. The pullback should not rally above the high of the prior pullback. This violates the rules of a downtrend. Also, take note that pullbacks may move in the opposite direction of the trend or may just move sideways, so you have to read carefully the price action. With the trend determined and the pullback occurring, you just wait for the engulfing candle trade signal. During a downtrend, wait until a down candle engulfs an up candle, and vice versa for an uptrend. No need to take a bullish engulfing candle in a downtrend or a bearish engulfing candle in an uptrend. If you do so, you are practically trading against the main direction. Once a trade is initiated using the engulfing candle strategy, you could place a stop loss above the recent high for a short position and below the recent low for a long position. The engulfing candle that occurs after a pullback in an overall trend is designed to get you into a trade as the next wave of the trend is likely to unfold. A rule of thumb is to make sure your winners are at least 2 times bigger than your losers. Therefore, measure the distance between your entry point and where you placed the stop loss. For example, if it's 30 pips or 30 cents, that is your risk. Your target price should be at least 60 pips or 60 cents to compensate yourself for the risk you have taken. In technical analysis, there are different tools that could be used in conjunction with candlestick patterns. The most efficient ones is the concept of support and resistance. As you can see from this example, the red candle was followed by 2 consecutive green bullish candles, forming on top of a major support area. This gives even further confidence to market participants and pushes the price higher. As you can see, after the bullish engulfing pattern is formed, the next candle is a long candle and thus marks the bullish bias of the market. In this chart, you can see the opposite scenario. There is a resistance area and the bearish engulfing pattern. As we have already decided, what matters is not the number of the candles, but the ability of the bears to engulf the bulls, thus showing market participants the readiness of sellers. So trade the pattern when it occurs at a strong area of support or resistance. That's very important. You cannot just enter a trade every time you see the engulfing pattern. Be smart, use support and resistance, and trade the pattern near those levels. I also like to use the 200 EMA in my trading analysis. In this example, you can see a 200 EMA and the bullish engulfing pattern. That is a great confluence of factors which leads to an increased bullish enthusiasm. And here's a 3-bodied bearish engulfing pattern. You can see how large the candle forming the bearish engulfing is. The reason for that is that the market is indicating a confluence of bearish factors, which lead to a lot of market participants shorting it after the completion of the bearish engulfing pattern. There are other tools that could be used in conjunction with the bullish engulfing and bearish engulfing patterns, like pivot points or Fibonacci levels. Don't forget that bullish and bearish engulfing candlesticks are extremely powerful when they are used in conjunction with the existing trend, and are having an extremely strong connotation, especially around support and resistance areas and moving averages. If you got any value from this, make sure you subscribe, click the bell icon so you'll be notified each time we upload, and leave us a like to show your support. Until next time.